On Friday morning, more than $10 billion in Bitcoin options contracts reached their expiration date. Not $10 billion in Bitcoin, $10 billion in promises about where the price might go. The contracts live on Deribit, the exchange that has handled most of the crypto options market since it opened in 2016. Every month, on the last Friday, a batch of those contracts settles at 8 in the morning UTC. This June batch is the largest on record. The notional open interest, the dollar value of all active contracts tied to this date, sits near $10.6 billion. That is roughly 38% of every Bitcoin option Deribit still has open across all future dates, concentrated into a single morning. After an 11% slide in June, about 80% of that stack is out of the money. So in plain English, 4 contracts out of 5 are betting on price levels Bitcoin is not near right now. Unless spot moves sharply before 8 UTC, those contracts expire worthless. The paper bet ends, and no coins change hands on the Bitcoin chain because of the expiry itself. In April 1973, the Chicago Board Options Exchange opened in a former smoking lounge above a bank in Chicago. Before that day, options on stocks were mostly private deals between two parties. You called your broker, you negotiated terms. There was no central list of strikes and dates on a board everyone could check. The new exchange changed the shape of the market. It published a menu, same expiration dates, same strike prices. Anyone could buy or sell against the same board. Farmers and grain merchants had already learned this trick decades earlier on the Chicago Board of Trade. Forward contracts on corn and wheat that let a grower lock in a price before harvest. The options exchange brought that template to stocks. The point of the machinery was never to move the underlying asset on the settlement day. The point was to let people trade risk about their asset's price. The corn still sat in the silo, the stock certificate still sat in the vault. What expired was the side bet. Bitcoin options work the same way at the structural level. A call option is a bet that price rises above a strike by a date. A put option is a bet that price falls below a strike. When the date arrives, the exchange checks spot against each strike and marks winners and losers. The Bitcoin network. Deribit's data for this Friday paints a lopsided picture. Bitcoin has been trading between $61,000 and $65,000. The max pain price for this expiry, the level where the most contracts would expire worthless, maximizing loss for option holders, that sits near $74,000. That is about 14% above where spot has been living. The heaviest single strikes tell the story in sharper detail. The $60,000 put carries roughly $450 million in notional open interest. Traders clustered bearish bets around the level Bitcoin tested at the start of June. The $80,000 call holds about $406 million on the optimistic side, bets that did not pay off in a month when price slid instead of rallied. The put-to-call ratio sits near 0.87. Calls still outnumber puts slightly, but the positioning is close enough that neither side dominates cleanly. After June's slide, the out-of-the-money pile totals about $8.6 billion, 80% of the $10.6 billion book. Deribit's DVOL index, which tracks implied volatility from option prices, sits near 42% heading into the event. Traders who watch vol for a living describe that as muted for an expiry this large. The market is pricing the Friday settlement as a big number on a spreadsheet, not necessarily as a crisis for spot. The timing adds one more layer. On Thursday morning, the Bureau of Economic Analysis released the May Personal Consumption Expenditures Price Index, the inflation gauge the Federal Reserve names in its policy statements. Macro traders adjust positions after a print like that. The options expiry arrives less than 24 hours later, at 8 UTC on Friday, while some of those adjustments may still be settling. Quarter end adds a third layer. June 13th is Tuesday. Pension funds and index trackers often rebalance around month and quarter closes. Friday's expiry sits between a macro print and an institutional calendar. A crowded few days for anything that touches liquidity, even when the underlying asset is unchanged. The picture is smaller than the scare stories make it sound. An options expiry is a cleanup of derivative positions. Market makers who sold options may unwind hedges they held against those contracts. That flow can nudge spot for a few hours. It can amplify a move that macro data already started. It can also pass quietly if most contracts expire worthless and hedges are small relative to daily spot volume. What the expiry does not do is change Bitcoin's supply schedule, its consensus rules, or who owns coins in self-custody. The chain does not know Deribit exists. A holder with keys in a hardware wallet owes nothing to the options market with a quarterly book clears. The asymmetry is the lesson. Wall Street and crypto-native desks have built a thick layer of bets on top of a thin layer of actual coins. The bets expire on a calendar and the coins do not. At 8 UTC Friday, two clocks run side by side. On Deribit, contracts expire against a spot price and dealers adjust hedges. On the chain, the block clock keeps ticking, roughly 10 minutes per block, same cadence since 2009. A quarterly expiry can nudge the price people pay for paper bets. It cannot move coins that nobody signed for. Settlement on the exchange is a mark on a ledger. Settlement on the chain is still a signature in a wallet. So, does a $10 billion expiry mean Bitcoin will crash or pump on Friday? Not by itself. Most of the open interest is already out of the money, which means a large share expires without exercise. The question is whether dealer hedging around the remaining in-the-money strikes is large enough to move spot in the hours around 8 UTC. What is max pain, and should holders care? Max pain is the price level where the most options would expire worthless. A useful map for traders managing gamma and hedges. It is not a magnet the chain enforces. Spot can finish the day far from max pain without violating any Bitcoin rule. How is this different from an ETF redemption day? Well, ETF flows move actual fund holdings. Coins enter or leave regulated wrappers. Options expiry settles contracts about price, but the underlying Bitcoin may not move at all unless a holder separately decides to trade. And why does implied volatility look low for such a large expiry? Because vol measures how much traders are paying for insurance against big moves, not how large the open interest number is. A quiet vol reading means the options market is not pricing a panic into Friday morning. That can change fast, but that is what the gauge says now. Does the PCE print on Thursday change the expiry picture? It can change how macro traders are positioned going into Friday, which changes hedging flows around settlement. The expiry mechanics are the same either way. The macro backdrop is the variable. So that's where we hold. 10.6 billion in contracts, and the coins underneath keep their own schedule. Thanks so much for joining us today. The channel will keep tracking post-expiry spot action, the next Deribit monthly cycle, and the mining difficulty retarget projected for Saturday. Subscribe and hit the bell to stay in the loop. Take care, everyone. See you soon.